So hello everyone, this is Kennedy. We are from the Hong Kong Polytechnic University. And today we will present our views on sound eviction. I believe that all of us have a very special year of 2020, which COVID-19 digitalized our lives in all means. Today, we are having this presentation online, which made available by Zoom. As a student, I'm completing my degree online. Also, due to social distancing, we spend more time with YouTube, social media, and start to shop more online. Well, undeniably, these names has been the huge beneficiaries of this digitalization theme. Our group have identified another hidden gem, which is data center. All of these platforms need to share and store data in data center and pay the recovery revenue for the space rent. Our group conduct research on the Hong Kong's largest data center, Valuation. We believe the company will expand its market dominance with ongoing support from the parent company and also the robust demand from digitalization and cloud adoptions. We issue a buy recommendation with Hong Kong dollar 9.57, indicating a 21.8% of upside. Without further ado, I would like to start with why we believe the company can maintain its leadership in Hong Kong. The strength of a data center business lies in four important factors, being the market share, cloud capacity availability, connectivity, and whether it is career neutral. We see that Sound Evision outperforms its peers in all aspects mentioned. Firstly, Sound Evision currently holds the largest market share, with 40% of future supply on hand. Sound Evision will double its GFA upon new project's completion. Second, the power capacity reflects how much space the company can provide to its users. Sound Evision is able to at least triple its capacity and being flexible on expansion. As for the connectivity services, it is now the most connected one in Hong Kong with top data center ecosystem. Lastly, Sound Evision is not only career neutral, but also cloud neutral and technical neutral. It creates a trusted environment for the clients to come in and use its services. Now, I would like to pass my time to Dora.
Thanks, Kennedy. Moving on to the second investment thesis, we believe Sound Evision enjoys strong support from the parent company. Sun Hung Kai Property, which is the world's second largest property developer, holds 85% of Sound Evision shares, and therefore it's in its interest to support Sound Evision. The parent company provides support from the following aspects. Firstly, secured land resources, including seeking new sites and reduce costs from 100% owning land. The parent company also provides flexibility for capital support. When the opportunity arose in 2019, Sound Evision was able to secure a shareholder loan for acquisition of new land to further expand its data center capacity. Also, we see booming demand for data centers from digitalization and cloud adoption. For the demand for data centers, Hong Kong enjoys its special geographical location and connects to 12 out of the 15 subsea cables, 10 of which terminate with Sound Evision's data centers. With the data privacy protection and government supportive measures, it attracts enterprises to use the data center services in Hong Kong. There are multiple factors that drive the demand for data centers. For example, 5G development, AI, and so on. For Hong Kong located data centers, the Chinese technology giants expansion plan, as well as the Greater Bay Area development are the factors that propel the growth for data center. Especially under the COVID-19 influence, there's a booming demand for cloud usage. Leading cloud platforms such as Microsoft Azure have announced their continuous expansion plan in Hong Kong. And overall, the cloud market is expected to grow at 22% CAGR in the next 5 years. And I'll pass it to Chen Kang to talk about the next part.
Yep, thanks, Dora. Moving on to valuation, we have employed discounted cash flow model and conducted a relative valuation. By assigning 75% weighting to our DCF valuation and 25% weighting to our relative valuation, we are able to achieve a target price of 9.57 Hong Kong dollars, indicating a 21.8% upside from the last close. Our current target price is a 14.5% upgrade from our previous target price. This is because Sound Evision recently disclosed 30% more available power capacity in the long run. We have chosen power capacity as a key revenue driver as data centers rent out power capacity for recurring revenue. Sound Evision did not disclose its power capacity available until last month, which has less than 5% difference from our initial forecast in the local round. We believe that this is one of the core reasons causing Sunny Vision to be undervalued, as the market was valuing Sunny Vision using gross floor area instead, which underestimated its earnings potential. So Sunny Vision's clear pipeline allows itself to attract demand from hyperscale clients as they are able to fulfill their capacity needs, which is rare in Hong Kong. As Sunny Vision receives long-term contracts from its clients, we believe that management's guidance is likely to be realized. Another key revenue driver is the rental pricing, and we have conservatively forecast a 3% annual growth rate for the next 10 years. Also, we note that Sunny Vision has a clear pricing table with its clients, which eliminates pricing concerns. Factoring in our investment thesis, we see Sunny Vision's revenue to double over the next 5 fiscal years. While Sunny Vision maintains an industry-leading EBITDA margin, we note that its profit margin might face pressure in the near term due to increasing depreciation and interest expense, as its new sites require high capex. Moving on to free cash flow, we forecast it to be negative over the next 2 years due to its 4.4 billion Hong Kong dollars in growth capex for new data centers. However, this will promise a significant increase in free cash flow over the long run. Also, while Sunny Vision did not disclose its maintenance capex, we forecast it to be at 5% out of total revenue by comparing to its competitors. Our sensitivity analysis using WACC and also terminal growth rate shows that there are limited concerns because even in the worst case scenario, it will still be a hold rating. We have also conducted a relative valuation using EV/EBITDA and compared to 9 current neutral data center service providers globally, and it shows that Sunny Vision is trading at a discount. To factor in Sunny Vision's bullish expansion plan, we have regressed EV/EBITDA to EBITDA growth of the comparable peers, and we are able to achieve a target price of 6.53 Hong Kong dollars. And thank you, and now I'll pass the time to Grace.
Thanks, Chen Kang. So for Sunny Vision, we categorize 4 types of risks, and here we will illustrate from the rental profits and capital structure perspective. So for the rental profits, the fierce industrial competition pressures the growth assumptions, mainly attributed in the utilization and rental charge. The geopolitical uncertainties, government regulations, and competitions all might impose threats on the unit income model. However, the downside is limited based on our scenario analysis, with the bear case still above the current stock price. For capital structure, the main argument goes to the dividend payout and limited capital reserves. With high historical dividend payout, Sunny Vision is expected to maintain the dividend in the coming years. However, due to the high current gearing and limited banking facilities, equity issuance might become the alternative. We estimate a 2.9 billion Hong Kong dollar equity issuance in the coming years, which increase the share price volatility. Coming to ESG, Sunny Vision demonstrates an overall satisfied performance by obtaining 8 related certificates in the past years. Now, let's take a look at different angles. Firstly, in the environmental perspective, Sunny Vision embeds green concepts into its center designs. Jointly with regular internal review, it managed to control its CHG emission per revenue 35% lower than its peers. The green design is a long-term solution to its cost management, which contributes to the higher margin. In the social aspect, Sunny Vision not only provides chances to employees, but also devotes in the community by creating values to different stakeholders. The high-quality services rooted in its IT infrastructure also ensure secure services, which increase the customer stickiness to consolidate the future income. In the governance aspect, we noticed that SHKP asserts its control with 74% of shares. And currently, there's more than 10% of revenue from the connected party transaction and a limited number of floating shares that bring some liquidity concerns.
1 minute.
However, it upholds the transparent reporting system, and the board inhibits strategy directions through the past practice, which we think the expertise can elevate the threats to a bearable level. In conclusion, data centers are seeing a structural growth which is accelerated due to the pandemic. And the parent support over the years had also granted Sunny Vision the unique assets to dominate the hyperscaler clients' power capacity needs. And Sunny Vision's market dominance is still underestimated and undervalued by the market. Thank you for listening, and let's open up the floor to Q&A.
Thank you. Judges, at this time, please turn on your video. You can leave your video turned on throughout the Q&A session, but please stay muted unless you are speaking. I will start time as soon as the judge utters the first word. Time will end at 10 minutes. Feel free to begin.
Okay, well, I might kick off then. If you could just talk through the difference between your two valuation approaches. Your peer-based valuation came up with a $6.50 versus $10.60 for the DCF. Why did you weight the DCF so much higher? And why do you think there's such a big gap between the two?
Thank you for the question. We have assigned 75% weighting to our DCF valuation. It's because, first of all, it incorporates the unique positioning of SunnyVision, and also it reflects like the future earnings potential and the long-term cash flow patterns, and therefore it can accurately reflect the intrinsic value of SunnyVision. Also, we took reference of the relative valuation because we think that the market sentiment is also important for data centers. However, we limit it to at 25% because it doesn't fully reflect the kind of unique positioning and the premium that SunnyVision is enjoying in Hong Kong. And as for the gap, I believe that it is also partly because that data centers are less discussed on the media as opposed to the other tech giants or platforms like Zoom itself. So in a way, data centers are less promoted, and therefore we see an opportunity in this space.
And also just a bit add on, I think it's partly because of the valuation method, because in our DCF, we use the capacity as our income driver. However, in the relative valuation models, we follow the average using the regression method of the peers. However, in the industry, they are always using GFA as one of the indicators, which we think somehow underestimated the power capacity, the earning power of the SunnyVision. So that's the reason there might be a gap between two valuation methods.
Thanks.
I'll jump in. Thank you for your presentation. The market drivers were pretty clear. Just wanted to understand, did you look at competitors and how much capacity are the competitors adding? And why are they EBITDA multiples higher for the competitors versus SunnyVision?
Thank you for your questions. I think I can start with why the company enjoys a higher EBITDA margin than competitors. So we believe that SunnyVision is quite unique in Hong Kong because SunnyVision owning 100% of its data center in 5 current ongoing projects and also 2 upcoming projects. So because of they are operate at an owner operating model, so they don't need to pay the rental profits to rental costs to others, which will drive the EBITDA margin to higher than competitors. Another point to mention is that SunnyVision is the market leader in Hong Kong. So they do enjoy the bargaining power than others. Which their pricing might be better than other companies in terms of earning potential. And another thing is that SunnyVision actually holds the high tier data center. So for data center, it's actually being categorized by first, second, third, and fourth tiers. 3 out of 5 current operated data center of SunnyVision is being 3 or 3+ tiers. So these will fulfill more clients' needs, and also they will attract more clients to come in, which will lift their margin as well. And another thing is the 2 upcoming projects are also being high tier data center. So we see that it's strength of the operations drive the EBITDA margin. So as for the power capacity compared to other competitors in Hong Kong, so we do believe that the land gas scarcity brings another strength for the company. The GFA is actually being disclosed for every company, so we can know the GFA, but we believe that the company is being undervalued because they actually charge based on power capacity. So the contract with the clients actually is based on the capacity availability, and other actually it's not normal to see that company will disclose that data. We are sure that SunnyVision will expand its capacity in the near term. And CK, could you please turn to the power capacity page as you can see from the graph. Yes, so after the new projections, phase 1 and phase 2, we see that there is still a room for their expansion in business. I hope this answers your question. Thank you.
Yeah, thank you. Sorry, my question was more around the competitors, how much capacity they are adding and why they enjoy a higher EBITDA multiple. That was my question, but it's okay to move on.
Yeah. About the capacity, I would like to add that in Hong Kong, in the next few years, there will be about 5 million land that is ready to deploy for data centers. However, only about 3.5 million land is ready for tier 4 data centers, which is able to cater hyperscale client demand. And among the 3.5 million GFA, Sunny Vision actually captures 1.4 million, which is about 40% of the future supply. And that is one of the key bargaining chips that Sunny Vision have to bargain to capture hyperscale client demand, because in the future, if the hyperscale client actually want to expand their capacity needs, they don't need to go to another data centers. They can just go continue with Sunny Vision. Yeah, and that may allow Sunny Vision to have the higher EBITDA.
Yeah, and I also think that Sunny Vision currently enjoys a high EBITDA margin, though the EBITDA is relatively lower. So just a bit above.
Thank you.
Hi, could you explain a bit on slide 26 how you select the peer groups for your relative valuation? Because I see that you choose some of the national player, given how Sunny Vision is focusing on one city only. Just explain a bit on your rationale.
Okay, so the first rationale is we want to choose the pure data center operators because, such as the non-career neutral data center operators like some Broadcom company, they might have some other business deviations that might interference with our EBITDA margin calculation. So that's the reason we choose, regardless whether it's international or local companies.
To add a bit on here, so the rationale of selecting companies, the first very important factor we take in is the company should be a career neutral operator. So for example, actually the second largest market leader in Hong Kong is PCCW, but the company is not a career neutral data center operator, so we didn't pick that company as our peers group. So we do select those global peers such as Equinix in our comparable analysis, because we believe that the company enjoys similar business model as to Sunny Vision. So as a data center, it not only provides capacity rent out, but also connectivity services and other value-added services. So you can see that from our 9 companies selected, they are all being truly operated in this industry. I hope this explains our selection criteria.
Yeah, thank you. Just a comment, like it would be more useful if you split different markets because the growth rate is too different and the market size is very different too. So you will always get this undervalued valuation if you compare it in this way.
Yeah, thank you for your
thank
comment.
You.
Let me ask you a question. So obviously the major shareholder is Sunny Group, which is a big developer, but they are not really into tech or data related business. So do you know what their plans are for this company in the long term? Is there a possibility to divest, or is there a potential for the parent company to have more like support or cooperation in terms of the actual business apart from real estate side? Can you comment on that?
Yeah.
Okay, so
sorry. In terms of the support from SHKP, first of all, if we look at the shareholder structure, they have already reached the maximum level, which is about 75% due to the as required by the stock exchange. However, therefore they can only provide capital support through shareholder loan, and in the past few years due to its capacity expansion. So that shows a very strong interest and also confidence by the SHKP, and therefore we think they are not likely to divest Sunny Vision. And moving forward, we think that as SHKP is very have strong expertise in property developing, which is actually very crucial for data centers, because data centers, we would argue that it is more of a property management business, because it requires a lot of electricity and space management that requires a lot of expertise from SHKP. Yeah.
Time. Thank you, Hong Kong Polytechnic University.